The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, joining us now here on the program, we want to have a wide-ranging discussion about demand and some of the picture that we're continuing to watch unfold here in the grain and oilseed markets, and look at this from not just a U.S. perspective, but a global perspective as well. Here to help us do that, it's been a little while since we've caught up with Steve Nicholson, Global Sector Strategist, Grains and Oilseeds at Rabobank. Steve, welcome back to the program. It is good to talk with you again, sir. Hope you're doing well.
Good. I am. Good to see you, Jesse. Thanks for welcoming me back. Also, congratulations on the new one. New parents. You look pretty good for a new 2-month-old boy at home.
My wife is a rock star, and I've learned to live off of Folgers coffee and naps. That's been how things have gone here, but We've been blessed. Yeah, we've been blessed. He's turned into quite a good sleeper, and everything's been going good here. And I was trying to think how long had it been since you and I talked? And it had been before we welcomed a new little one into the world.
Yeah,
so,
it has been.
Yeah,
at least earlier this year, and I certainly hasn't been since NAFB, but I could be wrong about that.
I think it's been earlier this year. So needless to say, we're long overdue for a conversation. So
sure.
Glad we got you on the show here today. Yep. Let's start this kind of broadly. I think we've covered it pretty well here on this show, and a lot of folks have covered it well. Just the current outlook in the grain markets overall. You got funds that are at or near record short in many contracts. There's been some weather risk talk out there in these markets. Okay, that's one little piece here. You have the commercial side that they're kind of just hand to mouth, so to speak, and getting it as they can get it. And farmers, a lot of farmers sitting on some supplies, or a lot of farmers who haven't done a whole lot of new crop marketing here just because prices have been somewhat unattractive. So I guess, did I summarize that well? Yeah. What's your perspective on how this whole picture kind of looks right now?
No, I think you have summarized it pretty well. And unfortunately, I think there's a lot of corn in particular is still in the country that needs to move. And it's been a bit of a weird summer in the sense that we came into the summer down, we've kept going down on price, and have sort of found a bottom or some support here. I think partly we've run out of bearish news. What else is there to say? And there's also not, there's no bullish news out there per se either. And so the market's sort of in this, and I call it the doldrums, is we're not going to go much higher, but we're also probably not going to go much lower here. And that's probably a good place to segue into the supply side, and we could talk about demand, because I think that's important to talk about the dynamics of demand side. But when you look at the supply side and you start driving the countryside, boy, it looks like a big crop out there, and crop conditions are supporting that view as well. And we believe we'll probably finally break that 180 bushel per yield ceiling on corn that we've never broke before. And if we get higher than a 182, 183 crop, it's a little bit Katie bar the door on the price side. But you look across, the winter wheat crop was better than we thought it was going to be. The corn crop looks really good out there, and I'm not disparaging those folks along the Mississippi River or along, northwestern Iowa, southeastern South Dakota, southwest Missouri. They've had a horrible summer, but the crop looks good in many, many areas across. Soybeans look a little ragged, but they'll come along. It's August almost, and then you start to, we'll venture a little bit north of you up into Canada, and I was up there last week, and their wheat crop, barley crop, canola crop look terrific. Unbelievable. They're expecting record crops up there as well.
Well, I think that supply side, you couple what the U.S. prospects look like with what's already on hand, the South American crop that we've seen, crops in the Black Sea region, although there's some challenges there too. China's had some challenges, but just that global supply picture at the end of the day, Steve, we just have a lot of supply and really not enough demand in some areas, it feels like.
Yeah, and I would agree, because you look at stocks on corn and soybeans in particular, you've built them up. Rice is back in a pretty good spot. Wheat would be the one that you'd be concerned about. But the demand side, the market's become very concerned, and I guess I'm going to probably be a little contrary here and say it's a little more nuanced than that. We came into this bearish market, gosh, 18 months ago or so, and the market was like, oh, there's no demand, it's going to zero. And I pushed back on it. I said, well, demand's still there. It's the complexion of it's different. So when the Russian-Ukrainian war started, everyone got, oh my gosh, I won't be able to get what I need. Supply's going to be a problem. So we rushed out there and we bought everything we could get a hold of because we remembered COVID and thought we couldn't get it when we wanted. And so you saw this rush of demand, or a lot of demand pulled forward. And so from the market's perspective, it looked like, wow, the demand's really good. And then you get on the backside of that and the demand slows down and it's not brought forward. The market goes, oh, it must be really soft demand. But let me give you a couple statistics. So if you go back to 1970, 71 crop year and look at global demand for corn, wheat, soybeans, and rice, there are 5 times in that time period, so we're talking over 50 years now, that we have seen a decrease year over year in demand. The biggest being 3.47% in 74, 75, when prices went sky high because of the Great Russian Grain Robbery. But since that time period, of those subsequent 4 years, the percentage decrease year over year has been less than 1%. And so I think people need to think about that. And the demand base is solid and continues to rise every year, which keeps us from going backwards on prices. And we're not going back to $2 to $3 corn. We always reference corn, obviously, but that keeps the support underneath prices, from a total collapse, because you have such a big demand base on the domestic demand to deal with and to support.
I wonder too, and I got some other thoughts on demand that we can get into in
Sure.
a second, but I had this thought as well, thinking about this, the supply side, and obviously growing a big crop. And I know a lot of farmers, their cost of inputs were very high for this crop, things like that. And a lot of us have seen things get below the cost of production here. So you got to be a little smart with your management. I wonder though, and I mean, I hate to say it this way, but I wonder if we got too comfortable with $6-7 corn and $14 soybeans, and now we're kind of in that position where we might not see that again for a little while potentially.
No, I don't think that's unfair to say. As prices go up, everyone is a hero and we're all geniuses, and it's easy. I mean, boy, I got $5.50 or $6 for my corn. I got $14-15 for my beans. I'm a hero, and so we tend to think, well, that'll happen again next year. And when it doesn't happen, then our first reaction is, well, we're going to pull back and wait for it to come back. And the reality is, that's not going to come back for a number of years. And if you look at U.S. stocks of corn, wheat, and soybeans over time, you do see this very cyclical pattern where we get into a situation where we build stocks and price comes down, and it's a 3 to 5 year sort of event. And then you get that situation where either the demand goes, which is what you want. You'd rather have a demand-led rally than a supply-led rally, because they tend to be a lot stronger and a lot longer lasting. But you tend to get those supply-led rallies like in 1988 in the drought, or 2012, and you get that huge uptick in price. And that usually, and then it takes stocks down, and then it takes a couple of years to rebuild. But you look at this year, we're going into La Nina year over the next couple of years, likely, which tends not to be an issue for North American crops here in the States. And so it does look like we're in a kind of a 2, 3, 5 year pattern of prices being somewhat in the doldrums. And so rallies, in my mind, rallies for farmers need to be rewarded as opportunities to be selling.
Yeah, that's a great point. Well, and to that point as well, I think you see, I mentioned this before, some unspoken concern amongst the ag community just with how things are looking, and some worries about what's going to happen when I go in for that operating loan at the end of the year. You see some of these major equipment manufacturers with layoffs and things like that. So it's, to that point, rewarding some of those rallies and protecting that bottom line, I think, is going to be the big key here in the short term, isn't it, Steve?
Yeah, absolutely. And I think it's, I'm not a banker, I'm an economist, so I have to say that
Yeah.
kind of as a disclosure. But when I think, when I talk to bankers about what is they're looking for in this time period, is they see farmers going into this and they're getting, we're through annual reviews now, but we'll be back into annual reviews, of course, in a year. And so they'll look for profitability. They'll also look for working capital. How has that been? And we know that we go through these cycles and we have to work through this. But I think that's one important thing. I think the other thing is to think about, let's say post-harvest here, and really when you start to get into harvest, the farmer's mind, once he gets it, he's probably 2/3 done or she's 2/3 done, she's starting to think about, well, what do I need to do for next year? And so you start to think about buying seed and fertilizer and chemistry, and do I need to make capital expenditures on machinery? Is there I'm negotiating land rents and all those sorts of things. And once farmers get that done, and a lot of them try to get that done toward the end of the year or right after the first of the year, so it's done and they can move on. But why not think about, at that point, you have a pretty idea how much it's going to cost to put that crop in the ground. Yeah, there'll be some expenses, but you have a pretty good idea. Why not start hedging against that when you get an opportunity, particularly if South America has some issues? You get that winter rally, lock in the margin and move forward. You look at what, hog producers, they buy that feeder hog, they lock in the feed and they sell it. Same thing, you see a bit of that, the cattle feeding guys do that as well. Lock in that hog crush, lock in, the soybean crusher is the same thing. Once they buy the soybeans, they're locking in that crush and moving forward. They're taking the risk out of the market for themselves and trying to lock their margins. And I think farmers also need to be thinking about that as well, particularly as we get into time periods where margins are going to be tighter, but also more difficult to, nail down.
We're talking today with Steve Nicholson, Global Sector Strategist for Grains and Oilseeds with Rabobank. And Steve, let's lean a little more into that demand side as well. Something you brought up to me while we were off air that I think is an interesting thing for us to maybe explore a little bit is, obviously, with all the global competition out there for the U.S. now, that's changed some of the demand flows, et cetera, et cetera. What could the outcome of the U.S. elections possibly, what role could that play in future exports? If we see a Trump presidency, for instance, does that mean tariffs on China and a trade war again? Some unknowns with what a Kamala Harris presidency could look like. You have RFK Jr. as a third candidate in there as well.
Right.
I mean, everything seems kind of wild right now on the presidential side. What's your thought on how this could all maybe shape U.S. trade and exports here for agriculture?
Yeah, I think what you said there at the end, this has been a wild side. I mean, who would ever write that we'd say one weekend we'd have an attempt assassination on one presidential candidate, and the next weekend his opponent drops out of the race at this late game. And so I think anything could happen. But let's talk about trade and a little bit of where we are in the world. So I've had conversations with people of late about the protectionists in the world. And you think about India, and we can come back to that. You think about what Mexico's talked about GMO corn, and you talked about, Europe. Some people would argue they're being protectionist with the EUDR, but you have all these restrictions that are seeming to come into the forefront that are going to restrict trade or slow trade down. Now, I will say my bias as an economist and also as an agriculture economist is that I think U.S. agriculture has benefited from free trade, has not been detrimental to them. And I'm not short-sheeting anyone from a standpoint that free trade has ramifications for labor and for industries in your domestic market. So we'll set that aside. But from an agricultural point of view, we have to remember that. I think the other piece we have to remember is that 64 countries in the world are having an election this year. Mm-hmm. And we know that things get said during election that sometimes don't come to pass because they're trying to attract votes or attract particular parties or particular sectors for their position. So I think with all that background, let's talk about the U.S. situation. Mr. Trump has been pretty clear that he wants to impose 10% tariff on everything imposed, coming into the U.S. He's also then said he wants to impose higher tariffs on China, which he did back in 1718. which we know how that turned out for U.S. agriculture, was very detrimental to U.S. prices. And also, I think we're still living with that today of, not very good soybean exports to China because of what happened back in 17 and 18. And I think producers are realizing that and thinking about that. We've had several comments from producers about that and thinking that's not a good route for us to go. The Biden administration, and we'll make an assumption here that Kamala Harris will be the Democratic nominee for the presidency on the Democratic side, has been also roundly criticized for not taking much action on trade. But let's keep in mind, they kept the Trump tariffs in place. They have not changed them. And so you would think if Ms. Harris would get in place and be elected president, that she would likely kind of be the same as we go, is we would continue to see those tariffs in place that Biden left in place. I don't know much about her record in trade. I think we're just finding out more about that. She hasn't really dabbled a lot in foreign affairs or trade policy until she got into the vice presidency. And so I think there's a learning curve for her and also a learning curve for us to understand what she will do. But I wouldn't expect much if she was elected. I think she would continue the Biden administration tariffs. But I am concerned, and I think farmers and agriculture in general, we need to be concerned to make sure that does not get worse than it is already.
It's a fascinating picture, Steve. This has been a great conversation, as always. Before we wrap it up here today, what would you reiterate to folks, farmers, ranchers listening in as they're trying to protect their market plan right now, things like that, the bottom line? What would you say to folks here as we work through some of this uncertainty?
Yeah, I think we talked a little bit about it, but I think it's a good idea to wrap it up. As the banker always tell you, make sure you understand your cost of production. Be thinking about that cost of production as you lock in inputs for 25. Make sure potentially hedge against that. I would think about hedging that because you've laid all this money out, but you've got this other you got the revenue side that you're basically wide open, and that's not a good idea in my mind, particularly in these states. So get your margins locked in and reward rallies, because you may not get them like you had the last 3 years, because it looks like we have fairly significant stocks of corn and soybeans, both domestically and around the globe. And that gives the market a lot of comfort. Like, I don't need to put any risk premium in this market because I have these stocks to back me up if something goes wrong. So stay vigilant.
Yeah, that's a good way, I think, to wrap it up. Global Sector Strategist, Grains and Oilseeds at Rabobank, Steve Nicholson. Steve, always good to chat with you, sir. Thanks for being with us today. We'll talk to you again soon.
You are most welcome. It's great to talk to you, Jesse. Good luck with the baby.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.